In the span of just 3 days, mortgage rates moved from multi-decade highs to the lowest levels in about 3 weeks yet again, as rates fell for the third consecutive day on Wednesday. In today's video, I'm explaining why this is happening. Also, stay tuned toward the end of this video because I have an update for you guys regarding foreclosures in the US. So thank you so much for joining me in today's video. I appreciate you. Let's begin today's video. So first, I want to share average rates according to Investopedia.com as of today, which is August 30th. The average 30-year fix is at 7.62%. However, when looking at the Mortgage News Daily as of today, rates decreased by 6 basis points compared to Tuesday. So average rates for people with great credit again is at 7.06%, coming off the highs we had about 1 week ago at 7.49%. For a jumbo loan, the average rate's at 7.24%, FHA is at 6.67%, and VA is at 6.65%. So 1 year ago, looking at average daily rates from the Mortgage News Daily, 1 year ago, rates were at 5.95%, a very small increase of about 1.1 percentage points over the past 12 months. I mention this because just about, on August 23rd, it was an increase of 1.6 percentage points. This is pretty crazy because I think it was this morning, I'm going to post a video regarding how rates are maintaining the highest levels since approximately December 2000. I don't want to confuse you guys because when looking at rates according to the MBA or Freddie Mac, they report weekly updates for the week as a whole. In contrast, though, the Mortgage News Daily reports daily rates, though. So the reports here can vary depending on your source here. I'll mention this again. I really like to look at daily rates because it really tells us the volatility that we've been having so far this year, especially compared to the past several weeks here. So for example, over the previous 3 days, daily rates have decreased by about 33 basis points, going from 7.39% that was set last Friday, now down to about 7.1%. On top of that, daily rates peaked at about 7.49% set August 22nd. That was the highest rates going back to December of 2000. But ever since then, we've been seeing this decrease of about 50 basis points. So you may be asking yourself, why have rates been decreasing? And the short answer is that we've been getting news or data regarding our economy slowing down. So when our economy slows down, or when we get reports regarding our economy slowing down, that actually decreases mortgage rates. As you can see right here, because according to this right here, the 10-year Treasury has now decreased to 4.112%. About 5 days ago, I should say not 5 days ago, about 9 days ago, the yield on the 10-year was about 4.3%. Now it's about 4.1%. So the yield has been decreasing, and of course, rates have also been decreasing as well. So why did rates decrease on Wednesday? One of the reasons is this right here. They reported 177,000 job openings for the month of August. The forecast was 195,000. So it came in weaker than was forecasted. And on top of that, July's numbers was 371,000 job openings versus 177,000 this August. So this implies that our labor market is slowing down, which is exactly what the Fed wants to see. They want to see the labor market slow down, and therefore that could be an indication that inflation is also winding down as well. And that's why mortgage rates decrease on Wednesday. And this is a report according to CNBC. It says private payroll data from ADP showed employers added only 177,000 jobs in August, which was lower than the Dow Jones estimate of 200,000. Therefore, based on this ADP report, it states here that job creation is slowing down, which again is exactly what the Fed wants to see in order to tame inflation. So that report was released on Wednesday, but also we had a downward revision in GDP growth for the second quarter this year, coming in at 2.1% annualized for the second quarter this year. The previous report regarding an estimate of GDP growth was at 2.4%. Now it's at 2.1%. And this also, of course, suggests a cooling off of our US economy. So in other words, bad news regarding our economy means good news for rates. Having said that, let's have a look at predictions of future rate hikes by the Fed. A really good tool I like to look at is the CME Fed Watch tool. If you just Google that, it'll take you to this. This actually provides the likelihood that the Fed will change the federal funds rate in their next meetings by the FOMC. The next meeting is actually in 20 days from now, which is on September 20th. And no big changes here compared to yesterday. I made a video yesterday regarding this. But yesterday I reported that there was a strong likelihood that the Fed was going to pause rate hikes in their next meeting. No big changes there. A 90% probability that the Fed will pause rate hikes in about 20 days from now. The next meeting is November 1st. And this is actually a little bit different compared to yesterday because there's a 50% probability that the Fed is going to pause rate hikes in their November 1st meeting and a 45.5% probability that the Fed will increase rates by about 25 basis points from 5.5% to 5.75%. This is actually a small increase compared to yesterday's chances here. Yesterday, it was at 42.2% that the Fed was going to increase rates by 25 basis points or 0.25 percentage points. And now again, it's at 45.5%. As you can see here, the probabilities change on a daily basis depending on incoming data. And speaking of incoming data here, on Thursday, the PCE price index, which is a closely watched figure regarding inflation by the Fed here, will be posted on Thursday. And then on Friday, we have the non-farm payrolls report for August, reported on Friday in the morning hours. So depending on the data in those two reports, could depend on the direction of mortgage rates this week. I also have an update for you guys regarding foreclosure numbers in the US according to Black Knight. So they reported that foreclosure inventory, so foreclosure inventory is basically a fancy way to say the total number of foreclosures in the US hit its lowest levels in about 15 months, while serious delinquencies continue to decrease. And by the way, serious delinquencies means at least 90 days or more past due on your mortgage payments. So based on this report here from Black Knight, which is a data analytics firm that supports the real estate and mortgage industries here, it says the national delinquency rate edged up by 9 basis points in July to 3.21%. But it was down 12 basis points compared to a year ago and remains within 12 basis points of March's all-time record low. So even though the rate actually increased in July, it still remains very close to all-time record lows that was set back in March last year. Meanwhile, serious delinquencies, 9 days or more past due, continue to improve, falling to 468,000, the lowest levels seen since the pre-Great Recession crisis, and down about 161,000 or 26% from July of 2022. Also, 30-day delinquencies increased by 35,000 for the month, while 60 days increased by 17%. However, though, when looking at total foreclosure starts, this is the beginning phase of the foreclosure of a house for July, still remains about 39% below pre-COVID levels. And here's a table showing foreclosures as well as delinquencies in the US here. Because again, overall, the delinquency rate of mortgages is at 3.21%, a slight increase compared to last month, but still down by about 3.6% compared to July of 2022. Meanwhile, the number of foreclosures at 26,300, down compared to last month, but still up by about 15% from 1 year ago. There was also only 6,100 foreclosure starts for the month of July, and that's down by more than 10% from last month, and also down by about 18% from July of 2022. Black Knight also provided the states in which they have the highest rates of delinquencies and also the states that have the lowest rates as well. So in regards to the states that have the highest percentages here, Mississippi led the nation once again at 7.65% compared to the national average at 3.21%. Followed after Mississippi was Louisiana at 7.12%, then Alabama at 5.4%, Pennsylvania at 4.97%, and then Indiana at 4.94%. So all these states experienced a decrease compared to 1 year ago, except for Louisiana. Louisiana is up by 0.74% from July of 2022. It's also worth noting here that the percentages here of less or far less than 10% is way below the peaks that was set back in 2005 as well as 2010. In addition to that, we're not too far off the all-time record lows. So for example, in Mississippi at 7.65%, not too far off the 5.24% that was seen back in March of 2000. And in fact, Indiana is actually even closer at around 5% right now compared to the all-time record lows at 4.44% that was set back in March of 2023. Black Knight also provided the states that have the lowest share of delinquencies as well. So leading the nation was Colorado at 1.95%. After that was Washington at 2.03%. Then Montana, Idaho, and then Oregon at 2.16%. So every single one of these states here have recorded a decrease compared to 1 year ago, except for Idaho, up by 10.68% from 1 year ago, which is interesting, especially given the fact that Montana is down by about 10%. If anyone has some intel regarding why this is so much higher compared to a year ago, please leave me a comment below. I will say though that even though it did increase by a fairly high percentage here from last year at 2.09%, it's still very close to the all-time record lows of 1.76% that was set back in May of 2022. They also provide the states that have the highest share of mortgages at least 90 days or more past due. So leading the nation was actually Mississippi at 2.17%. A big decrease compared to a year ago, down by nearly 22% here. After Mississippi was Louisiana, Alabama, Arkansas, and then Georgia. But again, compared to 12 months ago, each of these states here are experiencing a giant decrease compared to 12 months ago. These numbers here as well are well below the peaks that was set back in 2005. I believe Mississippi and Louisiana were impacted, or these numbers here were impacted by Hurricane Katrina. And that's why these peaks here regarding the highest share of loans, at least 90 days or more past due, were in 2005 in those areas. In contrast though, in Alabama, the peak was set at 5.6%. That was set back in January 2010 compared to about 1.5% this July. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button and also consider subscribing as well. Hope you guys have an awesome day. Look forward to seeing you on the next video.